we would like to go and pick some of the questions, because we have now around 18 questions from the participants. We have reached 128 participants at the time, but now there are 107. So some of them perhaps have some commitments and left. One of the questions, perhaps I would address that perhaps to Yvonne, if you don't mind, Yvonne. They are, first of all, they are thanking the reputable speakers, and they are saying that with regard to the pricing and reserving in the context of a fierce competition, which is in our case in our region here is very popular, the competition or price competition. How can the actuaries take into account the underpricing and lack of NatCat modeling reserving for very long period? So if the market is very competitive, how the actuaries will take that into consideration, particularly if there is lack of NatCat activities in the region? Please, Yvonne.
Okay, well, I mean, I see maybe two parts of this question, but I'll try. In terms of taking into account underpricing, hopefully that's coming through already in your data, right? So if there is underpricing, your loss ratios are going to be high or very high, and the business is not making money. So as an actuary who's doing pricing, you should be seeing that in the data. Please remember Hitton's comments about making sure that you're using you're using appropriate loadings for reserves that might be in the data. You're using ultimates, right? But make sure you're using ultimates in your predictions, and then just make sure you're pricing according to what the data is telling you, right? If there's underpricing, you're going to see that you're not making money. So make sure you account for that. Now, depending on the company and depending on how things work, the underwriters might not take that information or might not write policies at the price, or as you said, the environment might mean you might not be able to write policies at that price. But that is now a different conversation, right? That is the company taking the stance that you're continuing to be in that market, knowing that you are possibly making loss, but you still want to retain the market share. But as the actuary, definitely stick to what you're seeing, stick to your analyses, make sure that you are presenting the information as you see it, and so that people understand. So what is needed in that market is for everyone to understand. So you start with the people in your company, make sure they're understanding, and hopefully, you'll reach a point where we just can't make business. We can't write at this price. And when everybody understands that, nobody will be able to write at that price, and you'll eventually start having to increase again. But for actuaries, definitely make sure people understand. So don't just reduce the model prices because the market is competitive and so they won't take my numbers. Make sure they understand this is really what it is. Now, if you're going to make a strategic decision to do something else, that decision is a decision being made, but at least people should understand that the results that will come will mean that the book won't be very profitable, and then hopefully the market will be able to change. Now, the second part of that question, if I understood it right, was in terms of making sure there's cap provisions. I'm
yes,
not sure if
yes, they were talking about if there are, how you will price if there are lack of cat activities, not cat activities. So actually, I mean, you don't have claims, so that how we will be pricing that.
Yeah. Okay. So for in those cases, if you are writing a book that is cat exposed, you should ensure that in every price there is an element of a cat load. So even because we know how cats work, I mean, that's the reason why it's a catastrophe. It doesn't happen often, but when it happens, it's big, right? So it might be 0 this year, 0 last year, 0 the year before, but 10 years ago it was 100 million, right? So what you need to do is ensure that there's a loading in the price to represent the average cat over time. So obviously you're not going to put the 100 million in the price, but you shouldn't put 0 either. So you should put a loading so that the company will be able to build that cat load over time. I mean, because when that 100 million cat comes in, the company needs money to pay for it. So you can't not price for it. It has to be priced for it it has to be priced for somewhere, and you have to ensure that the company is carrying enough capital to be able to pay for those things. So it has the reinsurance in place to be able to help cover those.
Yes.
Yeah.
That's yes. That's why I mean, they know that actually 90% or 95% or even more than that is reinsured. So we'll say that this is actually the reinsurer's problem. My 1% or 2% I can manage, you know, but still, actually, as you mentioned that, not because you don't have claims for the past 1 or 2 or 5 years doesn't mean that there is no exposure. Actually, the exposure is there and it will come. And perhaps they can look at also some neighboring countries where they have similar exposure, how they have experienced some activities, not cat activities, but to keep zero because I don't have claims doesn't make sense at all, because it will come and it will hit big, but it's a matter of time and nobody win, you know. So I mean, fully agree with you, Yvonne. Thank you so much. Hiten, I have one question for you also from the reputable participants here. They talk about the machine learning. How the machine learning applications can help in reserving, particularly for like the frequency lines of business, like motor, for example. Does that can be a solution, or I mean, please?
So what we have done in our data, so I would not call it them from a reserving perspective, is what I try to do is, especially for retail line of business like motor or health, where there is too much of granularity of data available. What we do is we try to identify patterns in the data which are not necessarily available as part of the reserving exercise. What I mean is, for example, if there's a behavior of customer, or is there's a behavior about a particular risk factor, because at the reserving, when reserving is undertaken, it's done at a much more homogeneous or much more larger level. Whereas in pricing, because you want to attract one of the best risks in the market, what you can do is use machine learning algorithms or machine learning techniques to identify risk factors or other characteristics with the portfolio, which has a much higher or much different behavior. So it's like why even talk about machine learning? You can take a step back and just do a proper or a regular in the normal days used to be called as generalized linear model or GLM models. The only difference between the GLM and machine learning is, in GLM you had to identify what were the risk factors, and you need to typically identify them. However, with machine learning algorithms being there, what you do is you just give the data and you try to do an unsupervised machine learning. It will run the code again and again and try to find out its patterns automatically within the data and try to say, okay, this is the factor which I believe is more synonymous and much behavior. The outcome of this whole process or exercise is to look at, okay, can I see that portfolio separately? Try to identify why that behavior is either very good or very different. And is there any peculiarities within that portfolio segment which then subsequently can help you do a better reserving? Because if the business mix is changing in a particular manner, your portfolio will change rapidly, but you will not realize it, because reserving will be much more slower to adapt, because you're looking at much more larger or much less granular level. You're looking at much more homogeneity level at that level. So I think that's the difference between machine learning as part of input into the reserving process.
Very good. Thank you so much indeed, Hiten. Mr. Ahmed, if you can, one of the questions from the reputable participants, he's asking, or she's asking, about how to estimate the necessary and sufficient capital to face the risk of the under provisioning. You remember when you said that it's also part of the rating agency to look at the capital adequacy as well as the technical reserving adequacy. So how they will calculate the adequate or the additional capital they require to compromise or to subsidize the deficiency in the reserving.
Okay. Now usually these are predefined the capital requirement by different regulators. So we have Solvency 1, Solvency 2 are based in US and China. They have the cross There are different regulatory bodies, they have their own rating agency, they have their own capital requirements, so it's predefined. Now, some companies now, they are adopting their internal capital model. If you are using internal capital model, you can define or you come up with your approach how to calculate the capital. So if you take one line of business, for example, if a company writing only medical line of business, for example, so simply they will look at the data of their book of business and they come up with a distribution or how the whole scenario of the claims can be. Okay, so they come up with distribution for their claims. Then you will say how much capital I need to protect the company. I need, for example, to protect the company for at least 200-year return period. I need to protect my company for at least 250 years return period. So they, as a company, have to make a decision for how much return period you have to protect yourself. Usually the Solvency II, it's a 200-year return period they are protecting themselves. So based on that, you calculate how much capital required based on the distribution of your data or your claim. So for example, in actuarial techniques, you say, okay, my medical book of business, I will assume it is have a long-term distribution. I will calculate my distribution. Then I will calculate how much, based on my data, how much represent the 200% repeated or 99.5 percentiles. Then you calculate how that percentile, then deduct how much provision already in place. Then the difference will be your capital. So it will be mainly based on the company data and their exposure. So based on your data, you calculate the behavior of the claims and how the claim could be. Now, within the data might not necessarily represent all scenarios, because your data might not give you, if you don't have enough data, it might not give you an event that could happen 100 years. Okay, so you have to make sure whatever distribution or technique you are using, it would consider all different scenarios, we call it. Then you can come up with your capital. But it is it's not easy an exercise. It is a little bit technical exercise if you want to do it internally.
Properly, of course. Thank you so much indeed. Yvonne, if you allow me, I have a question for you, also from one of the people participants. When they talk about the IBNRs, does the reinsurance company calculate an IBNR separately for each insurance company, or they look at their whole portfolio and calculate an IBNR? So when you are writing business from 50 companies, do you take each company at a time and calculate like an IBNR or a provision or something like that for each company, or you take it in bulk?
Yeah, it really depends on the reinsurance company. It depends on how many the insurance company has, what sort of tools the reinsurer has in place. I mean, I've worked at companies where we do actually reserve on each contract individually and apply the specific contracts information to the policy. But I mean, obviously, to do that, we're not necessarily taking each contract one by one and doing it. We created a model that can work for all contracts at once and might have some matrices behind that get applied, so you'll be able to transition as the contract gets older, right? You'll use different methods and things like that. So that it is possible to do that. There are definitely companies that can and do that. But again, it also depends on how many contracts you have and what sort of structure is in place and whether or not you have the capabilities to do that. I mean, most companies do use like ordinary, triangles, aggregate, and do the projections, but then they might split their data again into other subsets, depending on whether or not you actually see a trend, right? So the reserving, you try to put homogeneous groups together and do a projection for those together. But then where there are differences and you can see that and that affects your data, then you might split. So you might split by type of contract, whether it's like facultative or treaty or something like that. You might split by region. You might, as you were saying with some cedants, you might find that there are cedants that behave in certain ways. So you might put your cedants in buckets and then maybe have reserve for some cedants together, another set of cedants. If if it's worth it, right? So sometimes, you know, reserving does also in some ways rely on law of large numbers, right? So sometimes to break it down, and that might not work, and you might just be adding more work and effort for not that much return. So it really just, the answer really is, it depends. It depends on
Yes,
what your book looks like. It
absolutely.
depends on what your
Yeah.
capabilities are.
Yes.
Yeah.
You're absolutely right. And actually, I remember my friend Ahmed, when we were going through the quarterly reserving, actually he was looking almost at each ceding, and you know, some of the big, particularly, he has separate sheets for separate big accounts. So the big accounts, definitely, if they deviate by 1 or 2%, they will destroy the results of the company. You know, so these have to be looked at separately, not in a bulk like others. And also, if you have like, I would say, you know, like bad experience with some of the clients, normally they are very late with reporting of claims, or normally their claims are changing dramatically, then also you spend days out and look at them separately, not as a bulk of your portfolio. So it depends, actually, as you said, Yvonne, and it will take a lot of granularity, but also by the time you get the experience that these accounts I have to look at separately, and those others I can bulk them or, you know, cluster them and do the analysis as one bucket, you know. But it's a long and tedious process, I know, but I mean, the actuaries have to do it, and actually we have to work with them to explain why this is late and why this is going up and why this should be reduced and so on.
Mm-hmm.
I have a question for you, Heten, if you don't mind. One of the participants is asking how they can calculate the IBNR for motor insurance and for micro insurance. I mean, of course, you know the answer better than me. I don't have the answer, so please, can you?
Sure. I think the whole process should talk about as to what is a different type of, what is actually the core portfolio that you have. For example, definitely need to separate the property damage portfolio, or the own damage that we call it, the third party property damage and the third party liability. These are the minimum three that I would recommend. However, I would also recommend that you should look at probably geography as another factor, because that the utility, at least when I look at a portfolio for some of the European countries, the behavior changes. And when I look at even in India, the behavior is quite different when I look at the claims behavior. There's also, for example, there are some terrain which is mountainous terrain, they have much higher frequency, and obviously the losses can be very different. Or you could have a segment of the city which is very populous, but at the same time very affluent as well. So third party claims can be much more different behavior. They might end up getting reported very quickly or settled very quickly, because the customers are very pushy, or they're chasing, and that's what it is. Now, once you have segregated the portfolio, I think for most own damage portfolio, whether it's third party property damage or a own damage portfolio which is related to property, the chain ladder methodology, both on incurred or paid, should give stable results largely. But one of the things that I typically always do is also look at frequency severity as a methodology, because sometimes the chain ladder at a total claims amount diminishes the information when if the change in the loss ratio is coming largely from either a frequency or increased severity. For two factors, because especially when I look at the inflation on the severity is not a function of local conditions. It depends on, you know, what are the repair cost, or there is a import, where the imports are coming from, supply chain issues and other challenges which are typically gets reflected as increased severity. So it's always nice to look at frequency severity separately. So probably do a chain ladder or a DFM on a reported claim amount or a settled claims amount, and also do separately on average cost per claim, and see whether this captures the trend, or the trends are stable or not. That will help you to estimate the understanding of the portfolio, to what is driving the underlying cost or cause of changing the loss ratios. TP, I think, is much more difficult and a very different proposition. For largely, it behaves on the how the speed at which the courts are able to settle the claims. Some of the territories have a very unified or streamlined methodology of estimating the underlying liability. There could be a formula approach where they allow for a future income prospects. There's a function around age of the insured, what is the salary or the income levels and what is the level of liability the insurance company should have. So some of these methodologies could be well established, or it could be a function of the court jurisdiction itself, and where they decide, okay, this is the level of indemnity which I believe is good enough, and then gradually this inflation, there will be a much larger inflation because the salary levels or the underlying the RPI, the retail price index, or the CPI index, whichever is driving the inflation in the country, might have a very clear resonance with the wage inflation, because at the end of the day, third-party liability claims are all about wage inflation, or what is the level of income that that territory has seen in the recent past. So that is where I think the biggest challenge will start coming in, is to estimate what severity should be happening. Also, another factor which is more critical within the TP liability is the tail, because if you don't know how long and on average the claim takes about a time. So in India, I can tell you that the tail of settlement is about 15 years to 20 years. Okay. And that means that's a quantum of uncertainty that I need to carry in my reserves for the inflation to be happening. Similarly, if there are delays happening, whether I need to pay interest. I know Middle East might not have, some of the regions might not have interest as a component because that's not acceptable. But what does it mean effectively that, do I carry reserves on nominal basis, or do I carry on discounted basis? Because some of these factors will also have a bearing, because what is the level of interest rates are going to use to discount the reserves? And some of these factors are key important and will vary by country to country. So these are key aspects one needs to really look at it before you can start looking at much more detail, because at the end of the day, data will be just data, but understanding and the judgment part will play a lot more critical aspects as far as reserving is concerned. The more experienced you are, the more you've understood the portfolio, that gives a better visibility. And as Ahmed said, try to do A versus C as much as you can. Try to evaluate your estimates and review the estimates periodically. One of the things that I do at my end, as I pointed actually, is to outlay what is my expected development in future quarters. For example, of the reserves of $100 that I'm holding, how do I expect the reserve runoff to happen? Do I expect to settle 25 in the next quarter and another 20 in the next quarter, and then compare? So it just not only gives me the quantum of outstanding or reserves that are balanced, but it also tells me where my estimation is going to be. The longer tail that I have, the better credibility can provide to my near future. But if my near future itself is underpredicted, you can imagine that my future is going to be much more underpredicted as well. So I think that's also should help you to really estimate the reserving process.
Yes. So much indeed, Hiten. Actually, now we have kept you busy for 2 hours. So if you allow me, we can take 2 more questions to conclude. If you allow me, quick questions. So I will address this question to Yvonne, if you don't mind. The question is, if you can explain in short terms or short statement, how we can calculate the unexpired risk reserve, say for a property line of business.
Okay, so the basic concept behind the unexpired risk reserve is that you are trying to make sure you are estimating a provision for cases when the claims, expected future claims and expected expenses are going to be higher than the unearned premium that you are holding. So that's essentially what you're doing. So all you need to do is try and estimate how much your future claims are going to be, maybe using your initial expected loss ratio or your ultimate loss ratios for the new year, depending on what you have, or your planning loss ratios. And then also estimate the expected expenses for the future that you're expecting to incur to service those claims or that premium. And then compare that to your unearned premium, see the difference. If the claims plus expenses are higher than the premium, you need an unexpired risk reserve. If not, you're okay.
Very good. Thank you so much. This is very, very good and very short. Thank you so much indeed, Yvonne. Ahmed, last question for you. It's 2 parts. One is asking how he can deal with negative IBNRs. So if he has like a development pattern and he has an IBNR that is negative, how he can deal with that? Can he consider it 0, or he will, I don't know, take it as a negative IBNR? I didn't understand, but I thought the actuaries can respond. The other question is, is it important for the insurance companies to take share on the excessive loss program as a co-reinsurer? Is it helpful, and how the reinsurers are looking at that? Does it give them some comfort that this company is also, you know, like satisfactory with the business they are writing, with the expected claims and so on? So if I have an excessive loss, for example, of 5 excessive 1, is it important for the insurance company to take share of that 5 million layer, like 10%, and reinsurers will take 90%? We are seeing some of the cases like that. Is it important, and how this reflect on the reinsurer? And the other question is the IBNR, negative IBNR. Please, Ahmed.
Yeah, regarding the negative IBNR, I would assume it is not negative IBNR, it is IBNER. So a development on reported claims.
Okay.
So
all right.
if they have an outstanding reserve, which is they believe it will be reduced, or if they have now mainly in the motor, they have the salvage, it has not been sold. So it's mainly, it will be a development on a reported claim, but the information is not enough to come up for the reserve to give the correct number for estimation for the reserves. So it could be developed negatively. So I would say it's negative development on the IBNER, development on reported claims. For co-insurance on the programs, yeah, usually insurance company, if they believe the program has been priced well, so they will have a share on that. So it depends on the appetite of the insurance company and whether that layer is priced well. So they want to take, if their risk appetite, they want to take some share of the risk because if it's priced well.
Yes. Yes, and also it will give the comfort also to the reinsurer that we are managing the claims properly, and not that every claim that will exceed the priority will be ledgerly, you know, managed, so that the reinsurers will take the full amount in excess of the priority. But actually, I'm sharing with you the risk also on those layers. And also, Ahmed, as you mentioned, sometimes when the layer is very expensive, you know, you want to take part of that to, you know, to keep some of the premium. Unfortunately, we are not able to take all the other questions. They are very valid questions, but I would like to conclude by one comment from one of the reputable participants here. He's saying that very well done, fair, very knowledgeable speakers indeed, put together for our benefit. So I really would like to thank you very much, Yvonne, Ahmed, and Hitin. And also, I would like very much to thank our participants. Currently, we have 97 participants live. I mean, this is very good. I mean, particularly, we have spent 2 hours now. But really, you have given us a lot of information and a lot of knowledge about this particular topic, the technical reserving, in the simple words and on practical grounds. You know, I was always trying to make sure that it is really something that we non-actuaries can understand, and you made that happen actually. So I would like to thank you so much. Thank you very much indeed, Yvonne. Ahmed, thank you so much. Hitin, thank you so much for being with us.
Thank you.
It's really a pleasure. And we look forward to also to have you again in some of our future events. All the best and have an excellent evening, everybody. Thank you so much indeed.
Thank you.
Thank you.
Thank you. All the bye-bye, all the best. And all the thanks to also the reputable participants for sharing us and being with us. We apologize for not being able to take all your questions, but it has been very informative. Thank you so much indeed.